So today we had our Bank of Canada rate announcement and they've decided to hold the rate steady. So that was interesting. I'm not sure a lot of people were expecting that. I think with the trade war and the weakening economy, a lot of maybe consumers of the market were anticipating another decrease in the Bank of Canada overnight rate. But the challenge that they're finding is that they have two opposing forces. They've got this downward pressure on the economic situation. We're seeing just less trade. I think we all agree we're in a per capita recession right now. You can see that there's rising unemployment in Canada, falling oil prices due to either weakening demand or speculation of weakening demand, lower consumer business confidence. We're definitely seeing lower confidence than ever. But we also are going to see the elimination of the carbon tax, which is going to lower headline inflation for the next 12 months until we get through a whole cycle without that carbon tax factored into prices. So that's going to shift things slightly. But usually the Bank of Canada will decrease the interest rates when we have downward pressures on the economy, trying to boost the activity by lowering the cost of borrowing, incentivizing businesses to get out there and buyers to get out there to participate in the economy by keeping their borrowing costs low. The challenge that we're having is with the tariff situation is we have an inflationary pressure on our economy due to these tariffs and this trade war where everything's going to cost more. The stuff that we bring in, and then of course, all the stuff that we export is more expensive in the US. People don't buy it, then our companies suffer, and off you go. You have the results of a trade war. You also have this challenge with the supply chain that can also increase prices, therefore increasing inflation and scarcity pricing. Now that you can't get these items, the producers that can produce can elevate their prices because now there's less competition. And that is what the Bank of Canada is having challenges with right now. So they've decided to keep their bank rate steady. So what that means for your mortgage is nothing. If you have a variable rate mortgage, nothing's changed. And your fixed rate mortgages are influenced by the bond market. And of course, in all of this, we've had a wild swing in the bond market. You can see just the other day, bond market went up by like 30 beeps. In some cases, here we're at 2.83. We were just at 2.5. I mean, it's wild. And just to think that, back in January, we were sitting at over 3% in the bond market, which influences those 3-year and 5-year fixed rates. We have been encouraging our clients, whether they're renewing soon or getting a new mortgage, to lock in your rate holds now, because we knew that there was some downward pressure. We were having these rate decreases, but there could be inflation or inflationary concerns that show up with, the US Canadian dollar issue. And then, of course, now as the tariff war has become more prevalent, creating potential inflation down the line, which could then actually start to see interest rates go up, which obviously would impact your borrowing costs. So definitely get in touch with a mortgage broker if you're renewing or buying anytime soon.